class, so let me go ahead and get started. It's 5:30, which is when we begin our journey into financial statement analysis. Let me share my screen here. You might be wondering why I'm doing this. It's in case you guys miss class and you want to watch it again. Where did my share screen? Oh, it's the big green button in the middle. This is looking like right at me. Okay. Now it's frozen. Is that how it's going to be? That's a great shot of me right there, mid-frame. All right. So hopefully you guys have access to the slides. I didn't bother putting in my name and presenter's title. You guys know who I am at this point. Many of you guys have had me as a professor before. These slides actually come from the CFA Institute. And the textbook that comes with this, I believe, is free. At least I've seen my students in the other class download the PDF off the internet. So what I will be expecting you guys to do, because the university sort of has a free textbook only policy, in some of my past classes, we didn't really have a free textbook, so I limited my text questions to the slides. But we do actually have a textbook in this class that is free, so it's going to be fair game. Anything that is in those textbook chapters, which are roughly 30 or 40 pages each, and also whatever is in the slides. So I'm hoping to kind of present this material in an intuitive way, but I also want to manage expectations. Everybody here is an accounting major, right? Okay. Is anyone not an accounting major? Okay. Okay. Which class?
Finance.
Oh, finance. Oh, okay, good. All right. Yes. Finance also. All right. So we have a couple of folks from finance here. Don't worry. This is plenty relevant for you. And you might ask yourselves, why is a class on these financial accounting statements? I mean, that's what they are. They're created by accountants. Why is this class under a fin designation? And we're going to study that and uncover that in this chapter to some degree, and we'll rely on what you've learned in some of the other classes in this university. And again, I see some of my old students are back, so you'll get to apply some of the logic you hopefully took away from my past classes. Those of you who have had me before, the syllabus should look super familiar. Okay, we're going to divide the class into chapters that will be presented over the course of a week each. Okay, I don't think there are any exceptions here. Maybe chapter 4, I'm going to take 2 weeks to present that one, but I just want you guys to remember how to read this sort of calendar. You will note that today is not September 1st, and yet for the week of September 1st, we're supposed to study chapter 1. You interpret that as follows. Well, the week of September 1st is the week where the Monday falls on September 1st. Okay? All subsequent days, September 2nd, for example, and September 4th, those days for this class will be spent covering that chapter. And I will begin to take role in this class probably starting next week, because I know a lot of people are dropping in, dropping out, dropping in, dropping out. So obviously, I welcome all of you, whoever applies to take this course. I approve them as quickly as I can. But, should you think that you want to take a different course instead of this one, I certainly understand. No objection for me. I believe in freedom. I believe in liberty. So basically, we'll start taking role in the week of September 8th. And we're going to move sequentially through these chapters from chapter 1 to chapter 10. So it really has a very nice symmetry, our schedule. After the presentation of a variety of chapters, what I will do is I'll give you an examination. And you can see that we have 3 examinations here. Each of them are worth 25% of the grade. And the remaining 25% of the grade is comprised of your final project. So the examinations will simply cover the chapters that immediately preceded them. So examination 1 will cover chapters 1 through 3. Examination 2 will not go back to 1 through 3, right? It'll go on 4 through 6. And examination 3 will cover the remaining chapters. So they're not cumulative. I just want you to kind of study the material that is set aside for each specific chapter. I think you'll find that's more than difficult enough on its own. What I do want you to sort of keep in mind, though, is you can't just completely forget the concepts. So, for example, in chapter 2, or actually with chapter 3, we'll cover what is an income statement. Okay. Now, you can't just forget what an income statement is for the remainder of the class and expect to do well. You have to know what the income statement is, and you have to know the items that are presented therein. So, for example, things like your cost of goods sold, depreciation, and so on will be in there. So don't forget chapter 3 entirely. That's not what I mean to incentivize by this exam structure. Just keep in mind that I won't be giving you hard questions on, let's say, the third examination about material that you covered in the first examination. Finally, the final project. That will actually be sort of presented mid-semester, starting in on November 10th. This is going to be a project where you pair up with 3 other classmates. Okay, I counted the number of students in here. We almost have 16, but not quite. I think some people are still missing. So you guys are going to form 3 or 4 groups, depending on the number of you. And you're going to have 4 or 5 people per group. And you will divide your responsibilities between creating from scratch, from a blank Google Sheets spreadsheet, a statement of cash flows, an income statement, and a balance sheet. Okay. You will create it from scratch and you will encode it with formulas so that when you're actually presenting this spreadsheet, I can tell you, okay, change the number in the cash slot for your balance sheet. You will change the number, and then all of the other numbers for the balance sheet should also adjust that have anything to do with cash. Additionally, all of the numbers in the statement of cash flows should adjust also, because cash is a common item between that balance sheet and that statement of cash flows. Yeah, I know somebody is sighing here. Yes, I agree. That might sound a little bit boring, but no? Oh, okay. Yeah, and that's the goal, precisely that. So what I will let your group do is pick a company that you happen to like, as I'm going to present here in the slides. Different companies present their materials a little bit differently, and you can actually use those as a template to prepare your statement of cash flows, let's say for Microsoft. Microsoft already puts out a statement of cash flows, so you can use that in order to prepare that statement. But obviously, I don't want you to just copy down the numbers. That's not much of an assignment. I want you to create formulaic relationships between these numbers in as many places as possible. And when you're actually presenting the project, and also when you submit the Google spreadsheet to me, I will go through and either instruct you to change some numbers or change the numbers myself and make sure that the formulas run. Okay? You should try to make your formulas as airtight as possible. That is to say, if there are some entries in a particular cell, right, that would be problematic, I want you to make sure that those entries kind of get caught. Okay, for example, let's say you have an income statement, and at the bottom of the income statement, you're splitting off your net income into dividends and retained earnings. But your income comes out to be negative. Well, you can't have a negative dividend, right? And there is a way to code your spreadsheet to eliminate that potential error. So that's going to be something that I'll be expecting. And as we get closer to the project presentation date, I will go over it further. You should note in the syllabus that I will be gone for a couple of weeks. So I'll be gone the week of October 20th and October 27th. Why? Well, I made a fairly good conference. One of my papers got in. One got in last year too. So I'm going to keep trying to go to this conference. It's the Financial Management Association conference. It's one of the 2 or 3 really big conferences in the United States. I will be honest, it is not the very best conference, but it is one that I am happy to make, and I'm going to try to keep making it every year. So to do that, I have to fly all the way to Vancouver, and then I have to fly all the way back. And because of other constraints in my travel, this is going to take a couple of weeks. Worry not. We will still have class. In fact, we will still have class in here. A GTA will come in. A GTA is a graduate teaching assistant. Will come in and She will turn on that screen and I will be in this computer and I will give you the lecture live all the way from Vancouver. In some cases, if I cannot do it live due to the time differences, then I will pre-record the lecture and it'll be available for you guys just like this one. So in case you ever miss a lecture, don't worry. I will record the lectures live in class and post them. It won't always be this class. As you all know, I have another section that I teach on Mondays from 7 p.m. to 8:15 p.m. So that is Mondays 7 to 8:15, Wednesdays 7 to 8:15. So you're free to watch the recordings from that session. The material is obviously the same. And I will post it in the Files tab. Okay, right here where you currently have all of your slides. Okay, so right now, all you should see here are the PowerPoint slides, but after today, you see this thing is being recorded, you're going to see this video. If I ever don't hit record, please remind me, because then I'll do an entire lecture and there's nothing to show for it, nothing for you guys to review. All right, so questions about that syllabus? Wait a minute, this is not the syllabus. Where did the syllabus go? I can't move this thing. Okay, here we go. Yeah. There. All right, so any questions about the syllabus, comments, testimonies? It's pretty straightforward if you've had a class with me, and this class is no different, and most of you guys seem like faces I've seen before. So I look forward to teaching you this material, and I'm going to kick right off. Before I do, though, be looking around the room and finding 4 people, or not 4 people, 3 people you'd like to partner. Okay, that'll allow you to have groups of 4. The other class, I promised them I'd give them time to like form groups, and then I forgot. So I'm going to forget with this class too to keep consistency. I'll give you some opportunity to do that on Thursday. Okay? Questions? Anything else? All right, good. Well, let's dive in. So you guys have the textbook. It's distributed by the CFA Institute. As you know, the CFA is a certification similar to the CPA, essentially to go out and trade various securities on behalf of others. If the company is more than, or if your clients are more than 15 in number, I believe is the cutoff, you're going to have a CFA. So I presume they make this international textbook that they put out there because some of this material will be testable on that exam. Anybody planning to take it? Okay, well, they make the textbook. Nobody is planning to take it for those of you watching at home. No, they make the textbook and it's available. So they also give me these slides to teach you guys. And I'm obviously happy to teach what the CFA Institute believes you should know about financial statements. And so today we're going to kind of summarize why we have them. So, I mean, they obviously provide information about a company. And you guys already know that because you took Fin 3310. So those of you who did take Fin 3310, why do companies publish these? Why do they publish these financial statements, like the income statement, balance sheet? For all of us, we can look them up every quarter. Microsoft publishes it, Apple publishes it, Alibaba publishes it. Why do they do it?
Maybe government present to distribute enough information because their stock is available on the market for common trust purchasers to purchase and to give those purchasers some information to make the right decisions.
That's actually a very precisely correct answer. That is exactly on point. The government tends to mandate these things. And the idea is that you are, in fact, providing information for decision makers. You can provide information for the CEO on how he's running the company. You're providing the information for the board members. If the company is not doing so well, they could fire the CEO. And you're providing information for shareholders and perhaps banks and lenders, whoever is lending to these companies. Now, the force of law is very powerful. Are there reasons that these companies might want to just voluntarily disclose these statements?
No.
No, not at all. Does anybody have a counter argument? Any thoughts? The answer is no, is final. All right. Well, since you say no, aren't companies trying to get people to buy their stock?
So,
Yeah, their stocks.
oh, I understand your point.
Mhm.
Even for the maybe common people, they want to achieve some information regarding the company's maybe ESG information in their annual report, so that they can trust something and then just purchase their products to be able to sell.
Yeah, so, well, let's put aside common people. Well, let's not put them aside. Common people invest in common company stock. So your initial answer was, well, there's these companies never want to distribute this kind of information to investors.
Yeah, but they do not want to, it's type of information too much because I have seen some big companies kind of stating such as Apple and Target. Their goal is to disclose as little information as possible to follow the regulations.
I see. You think that. Okay. I mean, as little as possible, but companies have different lengths of reports that they issue. Some are clearly disclosing more than others, presumably meaning they're disclosing a little bit more than what is required. If one company can disclose in 10 pages, why would a similar company expose in 100? But do you see kind of what I'm getting at is that you could use these statements potentially to market, right? Because you can say the CEOs are paid if stock prices rise. So you could theoretically use these financial statements to get people to buy your stock. After all, if your stock is getting beat down, but your income statement is really solid, you don't want to necessarily keep that private. You would publicize it so that more people would buy your stock. That would actually help your current shareholders and make them wealthier. Now, there is, of course, a disadvantage. And this is, I think, what you were getting at. Why would companies want to hide stuff, though? Like, there's maybe an incentive to disclose some things. Why would companies want to hide other things?
It is because that they don't want to give their competitors so many information. For example, in the Apple's financial statement, they just maybe refuse to disclose more information regarding what types of inventory that they have
Mhm.
and how they process their inventories. However, targets are maybe more likely to disclose that kind of information in more detail because it is not such a secret.
Yeah, that's actually also exactly or almost exactly on point. It's what how I would describe it. There is an advantage with keeping your cards down when you play poker, right? Because if your cards are up, people will know you're bluffing. Okay. Moreover, even if you're not bluffing, obviously there are many more possibilities in corporate finance that there are in poker. Even if you're not bluffing, you may have some plans to acquire certain plans, to go into a certain business, and you don't want competitors to catch wind of those plans and deduce, like, hey, this person is going to, this company is going to do this. We're going to either steal that idea or improve upon it in some way, or otherwise undermine whatever it is your company is trying to achieve. By the way, let me turn the lights on. It's gotten darker way faster than I anticipated, so hang on. Everyone's sitting quietly as the daylight wanes. Okay, all right, good. So here's an example. Now, this report of the quarterly results to me sounds almost like advertising, right? This maybe is not something Apple wants to keep hidden. They're doing great. Look at how great we're doing. But part of the reason that we want to have some standard requirements for what Apple discloses, and this is why these statements to some extent are standardized, is if left to their own devices, companies would only disclose the good, right? They'd never give you the bad. And as a result, you wouldn't be getting as good of a picture as you could be, right? If you're the government official, what is beeping and why? Do you guys hear that? Now I've been having tech problems in this classroom all day, Although it's never been a beep. Hopefully it's not ominous. Anyway, long story short, the government wants to make sure that the disclosures are not just the rosy disclosures. That is, we get the good and the bad from the company statements. Okay? So these are some old names for these statements. I will give you the names you might know them as. Okay? Statement of financial position. Anybody want to guess what that is? Because you guys study it under a different name, I suspect. Any guesses? No? All right. Statement of comprehensive income. Come on. You guys can guess what that is. What do we call that normally? My Fin 3310 people. Huh?
Yes, it is segregated into two different statements, which are the statement of, which are income statement and the statement of other comprehensive income. However, they cannot combine, and the statement of comprehensive income is its official name.
Yeah, we usually just call it the income statement. All right. The statement of changes in equity. We don't talk about that so much in Fin 3310. It's less popular. All right, statement of cash flows. Okay, that one, the name didn't change. So the first one is just the balance sheet, guys. Okay, and then the third one, statement of changes in equity, we usually call it the statement of shareholder equity. Okay, so that's fine. If you don't know something in accounting, Google is your friend, DeepSeek is your friend, look it up. And again, I'm not an accounting professor. My PhD is not in accounting. In fact, I don't even have a master's in accounting, as embarrassing as that is, or even an undergraduate. So what do? If you come across a term you don't know, you're just going to have to try to look it up and figure it out. Because as you might expect, even though we're in the world of the accountants, this information is highly relevant to us. When various reports come out from the accounting world, they get calculated into the formulas that we use to price stocks almost immediately. So, it helps to know them, and it helps to design various software that will take the numbers as soon as they're released, usually at the end of the trading day or early in the morning before the trading day starts, and interprets them and prices the security accordingly. So again, since we're in the land of accounting, you guys remember the famous formula for the balance sheet. Things must balance. The assets must equal to the liabilities and the owner's equity. For those of you who took my Fin 3310 class, I personally find this formulation, okay, assets minus liabilities equal owner's equity, as much more intuitive, right? What you have minus what you owe gives you whatever is left over for the shareholders to take home should they choose to dissolve the company. Now, I've got two companies here that the CFA Institute wants you to look at, and we have two companies precisely because their balance sheets kind of look different. They're companies in different areas of business, right? They're companies that have different amounts in virtually every line of their balance sheets, but you're going to find that the formulas hold. Okay, so this is Hershey Company. Anybody know what Hershey does? This, by the way, confirms what I say in the lower level class, which is, as informative as these statements are, sometimes even by looking at the statement, you can't tell what the company does, right? Well, Hershey is a candy company. They make chocolates. I'm sure they also make other stuff. Probably they have chocolate milk or stuff like that. But, that's been their chief area of business. Okay, and then this is a Swiss chocolatier, not Hershey's, but Hershey's competitor. Okay, and this is Lindt and Sprügli Group. I actually don't know. So I'm a big chocolate eater. I know it's not very popular in China. So I've definitely had plenty of Hershey's chocolate, but I'm not sure I've ever seen this Lindt and Sprügli chocolate. And I'm also confident I'm not pronouncing the name right. But the Swiss, just so that you know, are more or less known for their chocolates. So they're competitors, but their balance sheets look different. They look different with respect to the numbers. You can compare the numbers, and they are, in fact, different. Okay, but they also look different in their presentation. The key, though, is that they contain the same information, right? So you've got total assets, and then you've got total assets and shareholder equity. Okay, here you've got total assets on page 1. The whole page just adds up all the total assets. And then on the second page, we're going to add up all of the total liabilities and all of the total equity. So together, we now have a snapshot, because that's what a balance sheet is, of how a company is doing. Now, a lot of people like the balance sheet, but they like the income statement even more. So you guys know that the income statement sort of captures the amount of income, revenue minus COGS, minus all of these other things that we subtract over a certain period of time, right? Typically 90 days, all right? So the idea here is that you want to see the operations of the firm. And the balance sheet kind of gives you a snapshot over time. Maybe the assets in the firm really are worth what it says it's worth. They're worth. Maybe they're not. That's kind of up to debate. But the income statement tells you, okay, regardless of what assets the firm says it has on the books, what liabilities, what shareholder equity, how much cash is the firm actually bringing in? And that's its function, right? Now, the most basic thing, like net income, well, yeah, it's net income net of expenses, right? So income minus expenses. But the problem is that these things can get kind of complex. And so here's just one example. By the way, please don't squint at the screen. I know it's small. You guys have the file available to you. You can zoom in on it in your own PowerPoint programs. But basically, you start with the top line, which is the amount of money that you've raked in from all of your chocolate sales. In this case, it's still Hershey's, right? And then you subtract all of the costs that are associated with it until you get down to the net income number. And, this is kind of what the firm makes. Now, again, this is the accounting income, typically because items like depreciation don't really represent what is happening to, let's say, the value of assets on the market. Your actual income might be a little bit higher, but nevertheless, this is sort of the accounting estimation of what the firm is making under all of the assumptions that are associated with the firm's business proposition. And again, different companies, similar businesses, different companies, different income statements, right? They're going to look different. And again, please, because you're going to be making an income statement, right? You're going to be making a balance sheet. I want you to look at these styles, okay, and decide which ones you kind of like, because this is something that you're going to be presenting, and I'll need to grade you on your professionalism. Of course, you don't have to limit yourselves to just these companies, right? There are more than 3,500 companies trading on the US stock exchanges. They all have to file these forms. And congratulations, they're all available for free on the Securities and Exchange website. And they're also available for free on Interactive Brokers. I forgot to cover this part of my syllabus. Sign up for Interactive Brokers, guys. In this class, they're not really part of your final project. I can't think of a way to integrate them, but it's just such a valuable tool that gives you access to the financial statements of many companies really at your fingertips, boiled down to the most important numbers. I suggest you guys sign up. Those of you who are already here, you guys have accounts. Don't panic when it doesn't approve you immediately. It almost always takes 2 business days. So if you sign up, you'll have access not only to a free trading account, which I encourage you guys to use, but to just a wealth of information on all of these companies, which include their financials. Good, we covered that. I always forget to cover it in the financial statements class. So anyway, this is the income statement for Lindt and Sprogli Group. And now we kind of want to talk about the statement of changes in equity. So this is a financial statement that is not taught as often, but I want you guys to be aware that it exists. In fact, if you take the Fin 3310 series in our school, we'll tell you there are 3 main financial statements. And so guess what which one we leave out? We leave out this one. You know, earlier on the slide, I had 4 for you. And so it's like, well, why is it in earlier classes that we only teach 3? Well, we kind of skip the statement of changes in equity. Okay. So basically, I want to cover it in a little bit more depth. And we're going to look at it. I'm actually going to make the screen a little bit bigger because this one you guys have not seen before. The other ones you've seen, so it's not new. In fact, the other ones we've practiced the calculations in class and you were asked about them on examinations. This one you haven't really seen before. So again, the statement of shareholder equity captures the change in equity over a certain period of time. Again, usually like 90 days, but you can have one over 2 years and so forth. Okay. As simple as this might seem, you take the beginning equity, okay, plus whatever you calculate to be the change in equity, and that'll give you the final equity. All right. So, how do you do it? Well, you take the dollar amount of the beginning common stock, add all of the issuances. Okay. You add all of the issuances at the price at the par price, okay, at which the company issued. Now, yes, the price of those stocks changed almost immediately once they hit the market, okay, but I believe you want to use the par price in this case because, again, this is an accounting statement, not a statement that keeps tabs of the market value of these securities, okay, because that par value typically is what the company actually got from selling the stock, all right? So, plus issuances, okay, so this is any additional stock that the company issued at the beginning of the particular term, maybe in the middle of it. Why do companies do that? Why would there be any issuances? Is it hot in here? What? That was seemed to be your reaction. I mean, to me, it is. You know, they quit letting me turn down the AC to 18 degrees, which is unconstitutional. It's too hot in here for 21 degrees. It's 36 outside. Frankly, it feels like roughly 30 in here. But anyway, what? Why do we issue equity? To raise money, good for operation. Yeah. And maybe not always operation, but you could raise money to pay your employees. You could also raise money to buy a power plant, for example, if you're a power company, or a manufacturing plant if you're a manufacturing company. So you raise that money in order to invest in something that's going to make your firm better. Okay. Minus repurchases. What is a stock repurchase? Yeah.
Oh,
I don't know if that's her cover for she just doesn't know. Okay. Or if she really wants others to answer the question. Okay. We fixed to see about that. All right. Does anybody have an answer they'd like to try? All right, you.
Okay. Options is just a way that company can use to save money. Because if they just repurchase a share when the stock price is low and then reissue them when the price is high, they can just make it very profitable actually.
Yeah, they could, but that's typically not why they do it.
Okay, then this is maybe some knowledge that I don't know. I'm not.
I mean, I'm kind of with what you're saying is that companies can speculate their own stock.
Yes.
No doubt about that. But what is when I buy back my own stock, is the idea for, I guess the company to be engaged in speculation on the value of its shares, or are they trying to achieve something else?
Well, they don't need that money.
That's correct. They don't need the cash. So what are they achieving by purchasing back their shares?
Trying to reduce dividend.
No, not necessarily. Although I agree with you that share buybacks, share repurchases frequently take place as a dividend. What are they achieving? Does anybody ever own stock in a company that has announced share repurchases? What typically happens? Think back to economics.
Oh, understand that.
Uh-huh.
If there are less stock on the market, the stock price will rise after the repurchases.
Good. And so,
It makes them
yes. And so what does that do for the wealth of the shareholders?
of shareholders, for the shareholders that you sold their stock to the company, there was didn't change. But however, for other shareholders, their wealth increases.
Yeah, exactly. So because the share prices rise, right? The supply of the stock on the market has decreased. Let's pretend the demand has remained the same. When supply is decreased and demand remains the same, the price rises. Now the value of your portfolio has risen. So that's kind of similar to a dividend, right? Before a dividend, you held the stock, let's say it was $50, then you were issued a $2 dividend. Okay, now you're at $52 ideally. So as a result, you've become $2 wealthier. In the same way, I could achieve a similar result simply by decreasing the number of outstanding shares. Let me multiply everything by 2 so it's a little bit simpler, right? So let's say that the stock was worth $100 and you got a $4 dividend over the course of the year. Okay, so you became $4 wealthier. One thing that the company can also do is reduce the number of shares that is available by a little less than 4%. I'd have to do the algebra to give you the 3.9, whatever it is. It would reduce the number of outstanding shares by roughly 4%, and the price should rise to $104, right? You see? So I can make you wealthier in a different way. Very recently, that has been more popular. If you look at the S&P 500, the index companies are no longer paying as much of a dividend, but you're seeing their price rise anyway. The reason for that is because the number of share repurchases has really skyrocketed in the past 10, 20 years. So does anybody have any intuition on why are companies choosing share buybacks rather than dividends in order to make the shareholders wealthier? And clearly the shareholders prefer this too somehow for some reason. I'm asking you guys what you think the reason is, because if they didn't like that, they would vote out the board members that were approving the share repurchases. So why repurchase shares instead of pay out a dividend? You have to kind of think like an investor. To anyone that trades stocks, it'll be almost immediately obvious. But I suspect most of you guys do not actively trade stocks, so it'll be a lot less obvious.
I know the answer.
Do you?
Yes.
What is it?
Because substantially, if a company just pays them cash dividends or just repurchase their shares, they are just exactly the same thing as shareholders overall wealth. However, if the share repurchase can have another benefit, which is to increase the stock price and just give me maybe some signal to the entire market. And then
What would the signal be?
better.
What would the signal be if you repurchase the shares?
Maybe the stock price will rise and it can just inform the investors as the company is doing better and
Yeah, I agree with you. So it is a signal, but paying a higher dividend is also a signal.
but not so intuitive.
Does anybody else have a guess?
It's better for them to save their principal and avoid future losses.
Okay, you mentioned principal, which is going to be an important word here in a minute, but not quite. If you raise a dividend or you buy back stock, that's probably not going to guard you too much against future losses. The chances of future losses are still what they were before, at least in my estimation. Come on, what do you guys think? Think like investors. Think like, people that are just out there to try to make as much money as possible. Is there anything you want to avoid? I mean, obviously the stock going down, I get that. But what else would you want to avoid if you're just out there for the money? You don't really care about the community at all or anything like that. You're just there to make cash. What would you want to avoid?
Uncertain.
Sure, but this is not going to help you do that. What else? Ironically, it's more certain than uncertainty, what you're trying to avoid. It's one of the most certain things in life. Famously, it is said that only two things are certain: death and taxes. Okay? Now, when your stock goes up in value, do you get taxed?
No.
No, not unless you sell, right? So it's possible to get wealthier completely tax-free. You hold stock that is rising in value and therefore you're wealthier. When you get a dividend, do you get taxed? Yes, you do. You get hit by the dividend tax. Now, yes, if you hold the stock for 90 days or more, and these are qualified dividends, the tax is somewhat reduced. And if you don't have a very large income, it is in fact zero. But still, for all these guys on Wall Street, they're way past the threshold for zero tax. They're getting taxed at 15 to 20%. They don't like that. If you take 15 to 20%, and I mean, you talk about Elon Musk's wealth or some of these other billionaires, you're talking about tens and millions of dollars, maybe hundreds. So it makes a huge difference whether you get the dividend or if you get the share buyback. Now, you guys might be saying, but wait a minute, if I just have shares, I can't show up to Starbucks and pay in shares. Don't I have to sell the shares, incur the capital gains tax, and I'm still in the same spot? All right, how would the billionaires answer your question? Because that is kind of a problem. Frequently, you got to cash out. How do they get around this? Warren Buffett says he pays a lower tax than his secretary. How is he able to do that? I'm actually not sure if I'm not sure Buffett is doing this specific trick, but Bezos is famous for it. How do they get around it? How does Bezos have his $100 million wedding in Cyprus without cashing out any stock? It's important you guys think about this, by the way, because this is why finance is super complicated, because a person who hasn't thought about it would just be like, I'll just sell the stock and get taxed. But these guys on Wall Street, they're some of the savviest people in the world. So how do they get around it? It's beautiful. I mean, once I found out about it, I was like, I hope I can get really wealthy one day so that I can do this. How do they do it? That's actually really good. There is an IRS loophole that lets you do that over the course of 7 years. I bet you guys didn't know that. That's way outside. That's just something I happen to know. But that's not it. It's even simpler than that. It's something more intuitive that you can actually do in your fake Interactive Brokers account. What can you do? You got a whole bunch of stock. You don't want to sell it, but you want to get some money out. Why don't you use it as a collateral for a loan? How about that? Is a loan income? No, it is not. So Jeff Bezos famously never pays any dividends out of Amazon. Amazon has never paid a dividend. Okay. He takes his billions and billions of dollars of Amazon stock and he goes to the bank and he says, I would like a 1% loan, 1% interest. Okay. And if I don't pay you back, you can have these shares of Amazon stock. And the bank is like, okay, here's 100 million. And then Jeff Bezos throws his wonderful wedding in Cyprus. You see, he did not incur an income. He still withdrew $100 million. He used the $100 million just as if it was income, and he paid no income tax. Okay, so you see, it's very crafty. But that is why repurchases are so popular, especially these days where income inequality is just really growing in the United States and worldwide. We've just got some people that are really, really wealthy and some people that unfortunately are very, very poor. And the really, really wealthy, they have exploited this loophole to the nth degree. I mean, I'm frankly astounded. But anyway, just so you know, that's how the wealthy do it. Okay. Now, don't forget the issuances of stock are not the only thing that makes up shareholder equity. Shareholder equity increases, hopefully, okay? It hopefully increases because you have positive earnings, okay? So you're going to take whatever the retained earnings are at the beginning of your 90-day period or your year period, whatever. You add the net income for that same period, and then you subtract whatever is paid out in dividends, okay? So this will give you the ending retained earnings, okay? Retained earnings is kind of a funny number because, you would think if you made an income, you would distribute all of that income to your shareholders. And in that case, it's true, your retained earnings would be nothing. What does retained earnings means? Literally, earnings we have retained. We've held on to them, right? Because we didn't pay them out in dividends. So you have to make sure you do that. And so, again, that is going to, once you have those two together, right? You take the beginning, AOCI, add the OCI, and that gives you the final AOCI, okay? So, by the way, I also believe that this is fair game. So the notes, just like I can test you on what's in the textbook, don't forget to read these, okay? Because now that we actually do have a free textbook, I normally don't assign reading, but now I will assign it because, to be honest with you, the material is kind of difficult. So in addition to me talking about it in class, I want you to read about it, okay? So here's the thing. I'm going to try to make it bigger, and we'll just look at it because, again, this is something you probably haven't seen before unless you just really wanted to look up a statement of shareholder equity. All right. Well, okay. This is really funny because for me, I'm like in slide view and I don't know if that's going to show up on camera. All right. So I'm actually going to look a little bit closer because I can hardly see, even though it's a little bit bigger for you guys. Okay. So you can see that the firm is keeping tabs on things like preferred stock. Okay. That's just another type of stock. It's a way to earn money. The common stock. Okay. The Class B common stock, because remember, you can have 2 different kinds of stocks, 3 different kinds, 4 different kinds, right? Okay. Whatever the additional paid in capital is, okay. Any retained earnings. Treasury common stock, that's the stock that has been repurchased, okay. Accumulated comprehensive income, okay. Sometimes you've got losses there, so it could be a loss, okay. Non-controlling interests in subsidiaries, okay, because again, you can have little spin-off companies, okay, you technically own them, they're not independent companies, so that's part of what the shareholders would get if we were to dissolve the company right now, and you add it all together to get the total shareholders' equity, okay? So basically the idea is that you can keep tabs of everything that is happening here, and these are going to be alterations to various types of stocks. Okay? Again, I know it's small. The idea is that you guys review it on your own time by making it much, much larger. Now, to be gracious to you guys, because you haven't seen the statement, I will test on it, but I'm not requiring you to have that statement as part of your, okay, what is this? Go away, PowerPoint. I'm not going to require you to have this as one of your 3 statements. Okay. That's the one thing you're not going to be forced to recreate in Google Sheets. Speaking of which, everybody has a Google account, right? Like a Gmail. Okay. Those of you that have taken my class before, you'll definitely have one. If you haven't, please get one. We used to get one with Kane University. Your kane.edu email had one, but alas, it has been lost because Google has been overcharging universities. So the universities are like, well, we're just going to switch to Microsoft. And that's exactly what happened at Kane University. And actually happened at a bunch of my other alma maters. So the universities, I still keep their old email addresses, and a bunch of them have switched to Microsoft. And I happen to invest in Microsoft, so good for me. All right. Again, they look different depending on the company. So now statement of cash flows. This is what a lot of people care about because we tend to value projects based on the cash flows that they generate. Here, you essentially get the overall sum of the cash flows in and out of the company over the course of a certain period of operations. Again, usually 90 days. And we're going to divide them into operating, investing, and financing. Okay. Now, over here, we had a really good example. Young man said, one of the reasons you might want to sell stock is to fund your operations. Okay. So that's a great example of a financing activity where you're selling additional shares of stock, but you're paying off workers, and that's an operating activity. Okay. So sometimes the cash flows can show up in different places because of the way that we're defining them. Okay. And then remember, I said, well, it's also possible to sell stock in order to buy a power plant. If you're buying a power plant, that is an investing type of activity. Ugh, it's so small. Again, call the CFI Institute or the CFA Institute and complain their slides are so small. Just zoom in on it a little bit, okay, on your own time. It basically just talks about all of the things that you're doing in order to get down to how much cash you started with and how much cash you ended with. Notice there is a direct link to the net income, including non-controlling interest, right? There's a direct link right at the very top to the income statement. Okay. So this is what I mean in your final project. If I change something in the income statement, I expect to see a difference in the statement of cash flows. Okay. By the way, in your group of 4, one of you, you're responsible for the income statement. Another one, the balance sheet. Another one, the statement of cash flows. And the 4th person is responsible for presenting on behalf of the group. So pick someone that can think on their feet, because I'm going to ask them to change some numbers. Okay. And I want to make sure that those spreadsheets adjust. All right. Now, excuse me. So accompanying notes. Basically, firms are really different, right? In this case, we had 2 firms that are sort of in the same industry, but are still different. So imagine how different Microsoft is from Hershey's chocolatier company, right? So because of that, you sometimes need notes to say why you're deviating from various standards, right? So you can make some accounting choices, and I'm going to give you an example here in a minute. Okay, you can explain some stuff, why you're calculating things in a particular way. And you can also explain some details, let's say, of your loans. Okay, so that's an aspect of your liabilities, right? Maybe there's a contingency clause on some of your long-term debt. You can say, yeah, we've got a contingency clause, and explain the contingency clause as appropriate. Okay, now, this is a great opportunity for you guys to incorporate a new tool called artificial intelligence, right? Maybe you don't want to read the notes. Maybe the notes are somehow informative. Okay. If you see a company that's making a bunch of crazy choices in its accounting methods, you might think, hey, you know what? Maybe they got something to hide. So one way you can try to gain an upper hand on the market is you can run a lot of these accompanying notes through artificial intelligence. That's the thing that artificial intelligence has done for us. It has made the long written documents easier to summarize and to read quickly. It's not always right. In fact, every time I ask it a complex question, it's almost always a little imprecise, but it helps you think. And remember, when these statements come out, it only takes about 30 seconds for the market to price in their information. And that information usually is the numerical information because it's easy to take a numerical information and plug it into a formula. So what AI can do for you is that they can take these notes and make it into a number. For example, use DeepSeek, take one of these documents, put it in there and say, DeepSeek, give me a sentimentality score of the accompanying notes. It's kind of a weird question, but you can ask it to do that and it will do it, right? And so then all of a sudden you have a number. Out of a 100-page document, you've got a number. And maybe that number can predict the stock price. Now, yes, it won't be perfectly precise. How can you collapse 100 pages to one number? But if you only have 30 seconds to make a decision, that may be the best you can do. And you can be assured a lot of people are trying to game that and trying to do it. So here's an example because, accompany notes are better exemplified than defined. All right. So they want to describe what assumptions they're making about the property, plant, and equipment portion of their balance sheet. Okay. So they're valued at historical cost, meaning the cost at which they purchased that item. Okay. Minus whatever the depreciation was up to that point. The assets are depreciated using a straight line method. Now, just so you know, I think there are at least half a dozen methods. So you don't have to pick this one. Okay, they're letting you know they're using the straight line method. You can make a determination if that makes sense to you for a particular company. If it doesn't, maybe that's an indicator they're trying to hide something or trying to make things look better than they are. Depreciation on assets is calculated using the straight line method to reduce carrying amount to the expected residual value. So they're not reducing to zero, they're reducing to the residual value it would be sold for when it is basically junk, okay? And then they use the following lives. Remember, the lives, they form the denominator. Hopefully you guys had accounting 2200. They form the denominator by which we take the full amount, right? Okay, minus the residual value, divide by the life. Okay, so that denominator is going to have a great impact into, how things are depreciating over time. Okay, so again, here we've got the example of disclosure on a line item. Okay, this is the plant property. Okay, see, capital expenditure contracted for at the balance sheet date but not yet incurred is this. Okay, the future lease payments are, so they're leasing some stuff. And here's what they're connected to. Okay, we're leasing some retail stores, warehouses, and office space. So again, this is something maybe that is useful to us, even if you don't know exactly what they do or what they're planning to do in the future. They're not just a manufacturer. They're actually selling their own product, right? All right. So you also have management commentary. This one's kind of, what do you think? It's the manager talking about the company he runs. Do you think it's going to be like 100% transparent? Uh-huh.
Well, I have already studied some US companies making financial statements during summer vacation, and the management comments is the least part I want to read. Because
Okay.
I think it's somewhat maybe this should happen. And I only believe the data, how the data is interpreted.
Yeah, that's sort of how I view it too. The managers are going to spin this, whatever way makes them look best. They want to retain their job. A CEO whose positions are incredibly profitable. Tim Cook, the CEO of Apple, has recently noted that he has become a billionaire. Now, again, part of that had to do with his compensation for being the CEO of Apple. So the management commentary sort of tells you what the management team wants you to hear. But if it's what the management team wants you to hear, maybe it's a little unreliable. It's not, it doesn't give you the full picture. It only gives you the picture that is favorable to management. But it still may be useful because they might disclose some plans in there for what the company is going to do. And so that's another excellent opportunity to use artificial intelligence because, again, these management notes, they may be very, very long, but you can summarize them with AI and get a sentimentality score and use that sentimentality score to make investments. Okay? So, what do these contents of management commentary include? Okay? So, these IFRS practice statements that say that it should include the nature of the business, its objectives, its resources and risks, okay? The results of its operations, and some of the ways that it uses measures to measure its performance, right? Because, what are you going to use as measure? Are you going to use earnings per share? That sounds like a pretty good measure. Or are you going to use, the yearly depreciation, which sounds only tangentially related to what the firm is doing. So they need to articulate that. Okay. Now, again, speaking about legal requirements, the SEC requires listed companies to provide these. Okay. But again, even though they require it, it's hard to get the CEO to tell the precise truth. So, what are you going to do? Like, here's an example. This is Hershey's MD&A. Okay. Now, numerically, they're probably telling the precise truth. They can't really bend that. Okay. But, can they really say that their volumes increased due to the acquisition of Amplify and Pirate brands? Yeah, maybe they expect that's why. Maybe Hershey chocolate just got more popular. Okay. Maybe people have become more genetically predisposed to it. We've gotten used to eating it. We demand more, right? This is their best estimation that they're willing to disclose to us. Okay. Now, also, you've got auditors' reports. I got a buddy that's an auditor. What do? Let's say that your company, let's say Hershey's quit the chocolate business and they went into making steel, which, by the way, sometimes happens. Companies can drastically change what they do as a business. So let's say they say that whatever the dollar per ton value of a particular asset is, let's say they have a certain amount of steel at a particular plant. What does the auditor do? Do they just read it and they're like, well, they say they have 40 tons of, They count. How do they do that? This is a real life example from my buddy. He's like a big shot accountant now. I'm very proud of him. He's really done well since graduating college. Just, I think, with an undergraduate, and maybe a master's, and he worked his way through. What do you think he did? He just said, well, I guess they have it. Huh?
It is what they do is they just they just evaluate whether kind of students really exist in the maybe in the company's warehouse and
How are you going to evaluate that?
And the company recorded the value of the student accurately on their balance sheet as inventory.
Oh, well, I get that, but how are you going to evaluate that? They say we've got 40 tons. What are you going to do?
By doing some maybe expensive testing.
Like what?
They can just count steel like she has said, and
They would count the steel. How would they do that?
maybe they can use some tags like
So pretend you're Tyler Lottie, who's my buddy and roommate from high school, and what are you going to do? You've got to claim that this plant has 40 tons of steel in it. How are you going to evaluate it? You're sitting in your office, white shirt, probably not a tie, but a white dress shirt. What are you going to do?
If they cannot go outside, they have to use the company's transactional report and combine with.
Why can't he go outside? He's just sitting in his office.
But they can just achieve the transaction reports to.
Well, yeah, but that's how people launder money. I mean, they say they bought 40 tons of steel. Maybe they didn't. Maybe they wanted to give their friend a payoff. That's the whole point of audit accounting, is to make sure that's not happening. So what do? Hire somebody. You're the auditor. You're the one that got hired. What are you going to do?
I, so maybe just hire some people who are specialized in this, let them to count them and pay some money to them and
Yeah.
to
Well,
make sure that 40 tons is fair.
you guys, you're always thinking about hiring somebody else. I will tell you what happened in reality. Tyler walked out of his office, got in his car, and drove to the steel power plant. He arrived at the steel power plant, and they had these large coils of sheet metal, which they were claiming were 1 ton each. And he counted them. He literally could count them. All right, now, how did he know that each coil is 1 ton?
Well,
Google, come on. How is that going to help? Google is smart, but it's not going to know that particular coil.
and
How can you know the weight of a piece of coil from Google? You upload the image, you take a photo?
that's, and they make the Python message folders of.
Uh-huh.
So they can ask you to put on.
Oh, you'll ask ChatGPT if you don't, what if they give you 2 different answers? Come on, what do you think Tyler did? I mean, be serious, y'all. I mean, I know this is y'all's world, but think more practically. In the business world, you got to be practical. What do you think he did? No thoughts? Pretend you're at the power plant. Come on, guys. I mean, I know that many of you guys probably haven't had your first job yet, but one day you will. I mean, my first job was at 16, so to me, the answer is obvious. What do?
With the coin.
Yeah, you weigh the coil. So Tyler said to the plant manager, all right, well, he picked one at random. Why at random? Why don't you weigh the coil they give you? Any thoughts? If I'm the power plant and in reality I only have 35 tons of steel for whatever reason, because stuff happens, I can assure you, why don't you let them pick the coil?
They always provide.
Exactly. They will pick the coil that weighs exactly 1 ton. Okay. So Tyler went out, he picked the random coil, and he said, weigh that one. They couldn't have known which coil they were going to weigh. They couldn't have known which one he was going to pick. Probably if they had something to hide, they would have put their good ones toward the front so that it didn't look like, so that maybe the lazy auditor would miss it. So then he weighed the coil and weighed the right weight, and he went on his merry way. Now, he didn't weigh all of them. That's too costly in terms of time, right? I mean, the work at the power plant would have to stop because of that dead-gum coil, right? Now we got to weigh every one of them. That's all we're doing that day. That kind of audit is too expensive. Now, because the coil checked out and everything was fine, he could stop. Now, what would he do if the coil only weighed 1/2 ton? Okay, now you're going to have to weigh some more coils because that's actually a problem. 1/2 ton of steel is a lot of missing money, and there may be more of it. Okay, so again, always think critically. By the way, should you assume the scale is correct? Okay, so I don't know how he handled this, but you want to make sure. I mean, maybe it can weigh you. You know your own weight. Let's say it's not a ton of steel. That's too much. But you know your own weight. That scale should reflect your weight if you stepped on it. Again, I'm just telling you guys how to think practically, because if you letting him pick the scale is like letting him pick the weight. Okay. I mean, again, weights and measures, that's like a problem that goes back to ancient times. People have always been arguing, did I get the precise amount of gold or other product? So this auditing stuff is super important and super interesting. If you want to do a whole bunch of interesting stuff, be an auditor. Okay, because you're going to be out there weighing steel coils. You're going to be out there counting the cows in the field. Okay, you'll be out there doing all sorts of stuff, and you'll be getting paid for it. And you're being paid precisely for your honesty, because we actually do have to verify from time to time that the assets are there. Okay. All right. This is a good place for me to wrap up. Let me conclude my video. How do I do that? Where's my video? Okay, hang on. Stop share. I usually use Teams, but it doesn't work. All right, end.